there was a fear that Fed to reclaim credibility, it will sustain hawkish stance for longer, because they are going to look at average report card of theirs, right? In 2030, if someone were to write a biography of Fed of 2020s, it wouldn't say that, look, inflation came back in 2024 at 2. People will still accuse that you got that wrong, that it got to 6-8%. And so to some extent, an unwind of that is what Fed would like to see. Okay, would that come now naturally, given that finally the rates in US are much higher than the nominal GDP growth? So if the rates in, let's say, 4% US Treasury, whereas the nominal GDP growth will likely be 3% next year. So it's after very long, briefly on COVID, but otherwise very long, the rates are higher than nominal GDP, which is very disinflationary. And to that extent, it will slow economy very sharply.
Okay.
And that will mean that Fed will likely pivot, because inflation is delivering on its own, given what all Fed has done. And by the way, Fed and Fed and ECB and many other central bankers, not so much in India, but have tightened quite considerably, and its impact is seen with a lot of lag. So I think next 12-18 months, I am of the view that Fed will slow the US will slow faster than what market equities and bonds are anticipating. And to that extent, there could still be more surprise in terms of rate cuts, higher rate cuts than what markets are baking in.
So, therefore, just rounding off this piece on bonds, therefore, one would then think that being long bonds is a great trade, is a great structural or other positional trade with a 12-month, 18-month perspective or thereabouts, both US bonds, and would you extend it to other markets as well?
So US bonds, clearly, I was telling your colleague just a few minutes ago that had you bought US bond, 30-year bonds in the 90s, for good 20 years, it ended up delivering as much as 20-25 year ended up delivering as much as US equity markets, right? So if you get the cycle right and then get structural tailwinds or headwinds right, even otherwise a meek asset class, so to call, bond, end up delivering risk premiums that you do not anticipate. My sense is that if 6 months ago had you bought US Treasury's 30-year bond, a likely outcome for the decade would be that it would deliver as much or more than S&P 500 in dollar terms.
Right.
So I agree that there is a lot of structural tailwind for bonds over the next couple of years. But the cyclical tailwind is more significant right now. So my sense is that, let's say, 10-year treasuries are already 380. And a few months ago, I was forecasting that we'll head to 3.5. But then it's, very close. And my sense is that there is a reasonable probability that it can pierce 3% on the lower side, and thereafter even lower. So I am thinking that it's a likely old normal reclaim as far as bonds are concerned over the next 1 to 2 years.
That's a tall call. My final question before we take a break, and that is, because you've told me this crude is a deep insider, so on and so forth, right? There are other factors at play. Can higher crude prices, though we know that 2023 was a narrative around crude prices being very high, which came off as well, with reasons, of course. But can anomalies like maybe a higher crude price due to geopolitics or otherwise impact this thought of even the cyclical inflation being lower? We know structurally it's lower as per you, but cyclical inflation being lower in 2024, can that thesis get impacted by crude prices or some other factors?
Yes. So in a sense, forecasting business assumes base cases.
Yeah.
And then there are such big tails that, once we start to talk of it, people will lose interest in what we are discussing on. But yeah, if you were to tell me that crude were to be $110 year out,
then is that a possibility?
It is. See, crude typically is, in terms of spurts, it's a geopolitical proxy. So if we already in the midst of 2 major wars, but if you were to tell me that there's going to be a blockade of Taiwan, let's say, in this year or a year later, its implications will be significant. And so to that extent, or the Hamas war actually accelerates and gets escalated, so to say. And at Strait of Hormuz and places like them actually do experience disruptions in terms of flow of crude. then yes, it's possible. Typically, in absence of geopolitical risk, crude is a decent global growth minus 1.6%, kind of a volume growth forecast you can do. And so to that extent, because global economy is slowing, so therefore the global demand is slowing. So if you absence what you call geopolitical risk, crude has a tendency to disinflate. So that's how I would look at it. So can you forecast a war? Very unlikely. And which is why, and you know that there are already two major wars.
Yeah.
I wouldn't be surprised if, I've been of a view that, Ukraine war is a forever war, but I wouldn't be surprised if there is a ceasefire in 2024 as far as Ukraine is concerned, because for a variety of reasons. I'm not an expert in it, but I want to believe in something that I listen to with respect to some of these people talk of, is what's happening in Russia, Ukraine. There could be some positive surprise there, and that could potentially mean that, some more disinflating crude.
Well, one certainly hopes for that. Putin's comments overnight were maybe indicative of some of that as well. But we'll take a quick break on that note. Manish, stay on. Viewers, so this is one base case setup with some, how do I say, anomalies being spoken about. But ceteris paribus, Manish believes that this is how the macro could move. We'll try and understand investing implications from an equity side as well on the other side of this very quick break. Stay tuned. Back with Talking Point in conversation with Maneesh Dangi. We kind of set up how he thinks about the global macro and the bond markets in 2024. We'll try and do investing implications of that from an equity angle as well. But just before that, Maneesh, in your LinkedIn post, I saw that you've given, like there are 4 aspects to the post, which is the 3 setups and where each of these asset classes are, and then the 2024 joysticks. I'm just trying to understand. You reckon both equity and bond markets right now have gotten married to the setup 1, which is that there will not be a dramatically lower US economy performance, but more in line with what is a normalized deflationary, not recessionary move, and therefore markets will get ample time to adjust to it?
Yes, so they, as I said, they've converged, but I'm not agreeing to it. In a sense, market is a little bit of a probabilistic game, right? Whenever markets are too certain and cross assets, everyone agrees to something, there is no discord in them, but it also means that they may be sort of missing few things. As a matter of fact, the economy is slowing in US. As a matter of fact, the SAM rule, which is 50 basis point increase in unemployment, and you're almost sure of recession. So it is likely unemployment has risen there. Rates have been very high, and with respect to last 20 years, very elevated. So it's not unlikely that US enters into deeper slowdown than what market believes in.
And hence the pace of cuts will be faster.
Pace of cuts will be faster. So what is interesting is, from an asset allocation point of view, in both setups, in which one economy slows or in another that economy falls into recession, US treasuries rally. Okay. So that's a convergence trade, So to that extent, from a payoff point of view, it's a good trade. But the equities outcome is going to be divergent in both, right?
Right. So, and which is what I wanted to ask you. So typically, if it's the setup 1, then equities might also not have as bad an outcome. But if it is setup 2, right, wherein the rates come off much faster than anticipated, your argument seems to be that equities might not have a great run. But my question is that typically lower rates would mean the discounting multiples are in favor of equity markets, right, as opposed to against it. So could that negate or blunt some of the negative impact that could come in by a recessionary US equity market or recessionary US economy if we get to that?
No, surely, but in a sense, not at the preface. It doesn't have, markets rarely bottom at the instance of first rate cut. Markets bottoms much after it, okay? So we are at the peak right now, okay? We've unwound the entire 2022. And let us say if there were to be a historical template playing out in June, there is a cut. Historically speaking, markets will have to price an earnings slowdown of 20%. If we have a recurrence of what has happened historically in US, that the earnings go down on average by 20%. And therefore, market may have to embrace a historical P valuation, which is 17, instead of where it is right now at 19.5. So at $250 odd earning expectation on S&P 500 may actually move to $200. And therefore, at 17 times or 18 times, it's 3,500 S&P. So that's almost like a cut of 20%. So if there were to be recession and a typical template of recession with respect to earnings were to play out, there is a significant downside in US. You're right that after a few rate cuts, markets would begin to then reprice the earnings by elevated PE ratios. So there are 2 joysticks, right? One is a recession-led, earnings falling, which is depressing for market. And the other is Fed-led market repricing lower interest rates, which is inflationary for market. Both are actually fighting with each other, but that is after the recession call has been called out by markets, so a few months later, which is why that's how typical markets function. Frankly, we don't have much data. We have a data of 10 odd recessions in US, and this is what it tells us. Not statistically significant though, because 10 are too few. If Taleb were to be told this, he would laugh at me that, what do you mean? Thus data point and how does it matter? But this is how recession templates do play out. And to that extent, we have to be careful if setup 1, which we discussed, in which markets were forced to price recession, it will have to take cognizance of lower earnings. Right now, after 2 years of earning recession in US, markets are pricing an 11-12% increase in earnings. But that cannot happen in recession, because recession essentially means more unemployment, more inventory build-up, general slowdown, and therefore lower earnings.
Okay. So base case might be, as we wrap up this conversation, base case might be that both equities and bonds give a rally as things stand. But if the recessionary pressures are even more stringent or strong, then bonds may have an even more great time, but equities might falter.
So the base case is that bonds have good time. You know, it's a partner of, it's a good force now.
Yes.
On day and night. You know, either case, equity has a discord. You know, the outcome could be divergent in both the setups.
Good. Can I just do a quick 30-second answer, Maneesh? The big call, another big call that you made is that the US Treasury or the US dollar might have a reversion from what it has done in the past. I know time is short for, 30 seconds or 1 minute is short time, but can you quickly tell us what's the thought behind it?
See, currencies tend to have these structural or cyclical bear markets, 7-8 year. We've had a very long 15 odd year, 2018 to date, a bull market in US dollar for a variety of reasons, primarily crude and recurrent crises. I think, and from a valuation point of view, dollar is exorbitantly valued, almost 30-35% in my assessment. I think we are entering in a good 5-10 year bear market in dollar, because a lot of the forces, which is growth differential in US vis-a-vis rest of the world, mostly developed world, and the rate differential, both will be reverting to mean. And therefore, the tower that dollar is sitting on today would unwind. So I've been extremely bullish for last good 10 years. Every time you would have spoken to me, I think we are entering into a other side of oscillation where dollar will enter in a big bear market.
Okay, well, let's see how that unfolds. But Maneesh, Dangi, thank you so much for joining in and giving us this wisdom. Much appreciate your time.
Thank you.
And viewers, thanks for tuning in this edition of The Talking Point.